In this video, I'm exposing 7 secrets your bank does not want you to know, so you can start using the system to your advantage and make smarter money moves. The first secret is that banks want you to save money, but they don't actually save it themselves. As soon as they get your money, they invest it. When you deposit $100, you think it's safe and yours to use like an asset. But to the bank, that $100 is a liability because they owe you that money. That's because instead of keeping your $100 in a vault, banks use something called the fractional reserve system. This means they only keep a small part of your deposit, usually 10%, and lend out the rest. So from those $100, they might set aside $10 and lend $90 to somebody else. That person then has to pay the bank back with interest. They might deposit that money into their bank account at another bank, and then that bank does the same thing. It keeps a small amount and lends out the rest. This process keeps going, creating more money in the economy and increasing the total amount of money available. So while you think your money is safely sitting in the bank, most of it is being loaned out to people, making the bank money. Now, I'm not saying you shouldn't save money in the bank. I just want you to understand how the banking system works so you can use it to your benefit. So stick with me until the end because I will be sharing some ways to do that. The second secret banks don't want you to know is that they love when you spend money you don't have in your bank account. This is because it leads to overdraft fees, which makes banks a lot of money. In 2022, US banks made $33 billion just from these fees, so that should tell you something. An overdraft fee is a fee you have to pay when you spend or withdraw more money than you have in your account. Banks usually charge about $35 for this, and if you do it often, those fees can really add up, costing you a lot of money each month, which is exactly what banks want. These fees have become such a problem that the Consumer Financial Protection Bureau has suggested a new rule to limit how much banks can actually charge for overdraft fees. However, that doesn't mean that the banks are going to stop charging these fees altogether. The good news is that you can easily avoid overdraft fees by controlling your spending. Just don't spend more money than you have in your account, that way you don't overdraft. For example, if you want to spend $1,000 but only have $800 in your account, don't spend $1,000. If you follow this simple rule, you can save yourself a lot of money. I highly recommend checking your bank accounts every single day and tracking your spending so things like these don't happen. You can also set up alerts to notify you when your balance is low and check if your bank lets you link your checking account to a savings account. This way, if you accidentally spend too much, they can automatically transfer money from your savings account to cover it so you won't get charged an overdraft fee. Now, if you accidentally overdraft once or twice, something you could do is call your bank and ask them to waive the fee. They might do it the first few times, but don't make it a habit. The third secret is that you can use the bank's money to make money. There are a couple ways to do this. One way is by putting your money in a high-yield savings account that earns interest. Another is by getting a loan to buy something that will make you money, which could be risky, but if you do it right, it can really pay off. Most people borrow money from banks to buy things that lose value instead of make money, like cars, clothes, vacations, and other liabilities. For example, when you buy a Mercedes with a loan, the car starts losing value as soon as you drive it off the lot, but you're still paying interest on the full loan amount. In other words, you're paying for something that's worth less and less over time, while the bank makes money from the interest you're paying. Smart people, however, use the bank's money to buy things that earn them money, like real estate or a business. Personally, I like to invest in real estate. When I find a property I like, I check its location, condition, size, and how much rent I can charge. I then make sure the rent can cover the mortgage, taxes, insurance, and other expenses while still leaving me with extra money. For example, I bought this duplex a few years ago. My mortgage is $1,090 a month, but I get $2,300 in rent. After paying the mortgage, I'm left with $1,200. I set aside about $200 for potential repairs, and that leaves me with $1,000 in profit every single month. The best part is that I use the bank's money, not mine, to buy these properties. I'm also providing people a place to live. Each rent payment helps pay down my mortgage while the property's value goes up over time, making it a great investment. But like I mentioned earlier, this could be risky. So make sure to do your homework before borrowing money for an investment, whether it's real estate or a business. The main takeaway here is to stop spending money on things that lose value and focus on buying things that can make you money, whether that's rental properties, businesses, or even investing in your own education through courses or coaching programs, which can help you earn more money in the long run. Just remember to always consider the risks before taking on any debt. Number 4 is that online banks usually offer higher interest rates on deposits than traditional banks. Since online banks don't have physical branches to maintain, they can use those savings to offer us higher interest rates, no account fees, and often better customer service. High interest rates are important because they allow the money in your checking and savings accounts to grow faster. For example, if you put $10,000 in an online bank's high-yield savings account that earns 4% interest, you would earn $400 a year. But if you put the same amount in a traditional savings account that usually earns just 0.01%, you'd only make about $1 a year. That's a huge difference, which is why where you keep your money matters. Online banks are also just as safe as traditional banks because they have FDIC insurance. Plus, they usually don't charge monthly fees, like I mentioned earlier, or require a minimum balance to open or maintain your account, which means you can keep more money in your pocket. Many also offer you sign-up bonuses of over $300, which is basically free money, and helpful tools for budgeting, tracking your spending, and checking your credit score. Plus, you can sometimes get your paycheck up to 2 days early and even earn cash back on your debit card purchases, all benefits that most traditional banks don't offer. My top 6 recommendations for online banks are SoFi Bank, Capital One, Discover, Ally Bank, American Express, and Marcus by Goldman Sachs. I've done detailed reviews on these banks, so feel free to check out my other videos for more information. And if you're serious about growing your money, make sure to grab my free checklist in the description. It's packed with tips to help you find the best high-yield savings accounts and my top picks. Now, personally, I switched from Wells Fargo to SoFi, Capital One, and Discover years ago, and I've never looked back. So if you want your money to grow faster and avoid bank fees, consider switching to an online bank. You'll be glad you did. Number 5, your bank is not a financial advisor. While some banks offer financial advice, in many cases, it's not the best financial advice. You have to understand that banks are businesses, and they make money by pitching their own products like bank accounts, loans, credit cards, and investment plans. So their advice might push you towards options with higher fees and interest that benefit them more than you. So be very careful and know that your bank and their employees are not financial advisors. And many of the financial advisors who work at traditional banks aren't very good. It's not that they're bad people, they just have to sell to keep their job. That's why they become friendly with you to earn your trust and make you feel like they're on your side instead of the bank's. Then they convince you to sign up for a $30,000 line of credit that you never even plan on applying for, but since you trust them, you go along with it. This kind of thing happens a lot at banks. It's all about making money. You might have a great banker friend who wouldn't try to sell you something you don't need, but those people usually get replaced because they don't make enough sales. So if your goal is to get rich, you should listen to people who are rich and know how to make money so that they can give you real advice on how to do the same. Sometimes even people on YouTube offer better advice than someone at a bank. So if you don't want to end up with a basic life full of debt, don't take advice from your bank because most of the time it's not in your best interest. Unless you're a high-profile person using a fancy bank, then maybe the advice you get is a bit better. Number 6, banks can legally take money from your account to cover any debt you owe to them. For example, if you have a loan or a credit card with the bank and you miss or stop making payments, the bank can use money from your savings or checking account to pay off that debt without asking you first. It's a way for banks to recover what they're owed if you're behind on payments. For example, if you have $1,000 in your checking account, but you owe $500 on a loan or a credit card with the same bank, the bank may automatically take the $500 from your checking account to settle that debt. However, there are limits to this. Banks usually can't take money from accounts that are legally protected, like certain retirement or trust accounts. They also need to make sure the debt is owed to them, not to a different bank. Some banks may also have rules that prevent them from taking money from accounts holding government benefits or basic living expenses. That's why it's important to read the fine print in your account agreements to understand when and how your bank might use this right. I suggest trying to negotiate or make an agreement with the bank before they do this. But if that doesn't work, remember that they can take money out of your account. Even if you move your money to a different bank, the original bank will still come after you in other ways. They might freeze or reclaim the money from your other account or take legal action to recover the money you owe them. And number 7, banks make a lot of money from fees. Whether it's monthly account fees, ATM fees, overdraft fees, or foreign transaction fees, they profit from charging you for everything. Most of these fees are hidden in contracts, credit cards, and loans where they can be hard to spot in the fine print. So always read everything carefully and know what you're agreeing to. The same goes for bank accounts. Make sure that free account isn't charging you monthly fees that could cost you over time. One of the bank's favorite ways to trick you is through credit card promotions, where they ask you to spend a certain amount within a set time, and if you do, you earn a bonus. While this may seem like a good deal, it's really for the bank's benefit. The more you swipe your credit card, the faster they make their money back. That's because they hope that after you spend, I don't know, let's say $1,000, you won't be able to pay it all off right away. This lets them charge you interest and extra fees if you don't pay on time or miss a payment. But it doesn't have to be this way. You can learn how to use bank accounts, credit cards, and other banking products to your advantage. For example, you can open a bank account with an online bank that doesn't charge account fees and that pays you a higher interest rate on your money. When it comes to credit cards, only use them if you can pay off the full balance by the end of the month. For example, if you want to spend $300, make sure you have $300 in your bank account to pay it off completely at the end of the month. This will help you avoid fees and interest charges, and it'll also improve your credit score at the same time. You have to remember that when you use a credit card, you're borrowing money. That money isn't free. And if you're not careful, you'll end up paying interest and fees. So be smart and don't let banks trick you into spending more than you can afford. We know that's exactly what they want. I hope you guys learned a thing or two from this video and gained a better understanding of how the banking world works so you can benefit from it. The key takeaways are simple. Choose a bank account with no fees, high interest rates, and preferably a bonus because who doesn't love free money? Only use credit cards if you can pay them off in full to avoid interest and fees. Don't overdraft. Always read the fine print. Remember, your bank is not your financial advisor. And lastly, use the bank's money to make money. Anyway, if you like this video, check out this other one where I cover the 2 worst banks in America that you should avoid. You might be surprised to find out you're using one of them.